We've arrived at what I think is the kind of synthesis here, the major question, which is who's each of these for, right? If you're sitting in your chair at home, you make a certain amount of money, you're a certain kind of person, which of these is the right choice? And the answer is actually fairly clear in my view, who these apply to and how to choose. Farn, do you want to talk through solar and oil and gas here?
Yeah. Starting from solar, obviously high income earners, 300K plus, because the minimum purchase amount is 150K, right? So you want to make sure that you have enough tax liability to use the credits and depreciation against your income. That's important. You can carry forward the excess in each case, or worst case scenario, your income goes down or whatever. But I think from IRR standpoint, it would make sense for you to make 300K plus to make sure that you can use those credits and depreciation and can make the most benefit out of it. The other thing here is that someone who's on H1B is something that I've realized is where you are ineligible for solar. And the reason for that is that you cannot set up another business, cannot show material participation, which is crucial for solar to show active participation if you want to use it against your active income. If it's passive income, then it's fine. But if it's as long as it's active, you got to be active in solar. Regarding very quickly for oil and gas, same thing, 300K plus. If you put $1 in, you're looking at a 92, 94 cents worth of depreciation. For oil and gas, it's the same thing for H1B applies because it's the title of the GP in year one that as per our understanding, and we highly recommend consulting it with your immigration attorney, is to make sure that the GP status means that you are somewhat active and you're not spending any time, but the title here dictates that you are going in another business, you're running it. So that's another thing that people have to take into consideration. But for someone who's in H1B, you're not required to do any material participation. If you're busy, you have a very tight schedule, you think you cannot spend $100 into solar and you cannot do site visits and plenty of other things, then solar may not be for you. And you may want to look into oil and gas. Solar has this time constraint. The project has to be completed, right? If you are late in the year and you have missed the boat for the solar, then oil and gas is also there. So it depends which time, how much income, and what situation you have.
That's right.
For CLAT, we can quickly.
Yeah, and CLAT, I've hit on this, but the fit here is if you have a lot of money, especially a high income in a given year, if you have significant liquidity that you're looking to do something with, and if you're planning on potentially giving it to charity, a CLAT can be a fit. And the way I put this is very often we have folks coming in asking us about donor advised funds, about giving stock to charity, about these charitable strategies. In my view, a CLAT is a substitute for those strategies specifically. If you're giving significantly to charity, our view is that you should strongly consider doing that via a CLAT. But if you're not planning on giving significantly to charity, then a CLAT probably isn't the place to start, but rather you should be looking at solar or oil and gas. Looking at a couple of questions here around challenges. Since someone mentioned conservation easements, I think it's important to bring this out into the open and be clear about this. NEAT called out conservation easements as something that have caused a huge red flag for the IRS. Absolutely. And that's actually a major reason why at Valor we don't offer conservation easements. Before I move on, Ken, to answer your question, yes, you get to decide what to put into the CLAT. That's your choice. Cash, stock, flexible, very flexible. Conservation easements have been on the IRS's Dirty Dozen list. They've caused a significant number of automatic audits. Basically, every easement project gets audited. We don't touch them. Where we focus building the Valor business for the long haul is on things that have stood the test of time. Both solar and oil and gas are enshrined in statute and regulation, have been vetted by major law firms and accounting firms, and have passed audit when they've happened. So neither strategy is especially on the IRS's radar. Now, there are, of course, risks, right? With solar, solar is something that has been around for 25 years, but was supercharged as a result of the Inflation Reduction Act. And so we're in year 3 of solar being a major opportunity for retail investors. As Farhan said, none of our clients have been audited. The couple of audits that we've seen from other firms have been successful, or rather the clients have passed the audit. There is still that material participation requirement, and it's absolutely important that you do that correctly. And so we'll never tell you there's no risk. If you're concerned about not qualifying or not satisfying that requirement, or if you're concerned in general about the regulatory regime around solar, then oil and gas might be a better fit. It's much less subject to regulatory review. It's more of just a straight up investment strategy with a tax benefit. That's something that we can absolutely go deeper on in a call with anyone who's interested.
And just very quickly, Chip, before we over this, the a conservation easement is a listed transaction. You have to look at the underlying structure that what you are doing in that particular strategy, right? And for oil and gas, talking about this, it's a statutory, it's written in the tax code that you're not on the major thing here is the material participation on people's end, right? Unless you're buying a bogus project that doesn't exist, you're taking tax credits and depreciation for the money that you haven't wired. Other than that, there's an underlying asset project and other things on the solar side of things. That's one. The second thing regarding oil and gas is statutory. It's written in the tax code that you're not required to spend any hours in it. The GP status is enough. So on your side of things, what you are left with is on solar side of things is the material participation. That's the major thing, right? If you do it, you would know. If you haven't done it, you would know as well.
That's right. And just to answer a couple quick questions. Yes, if you're married, either of you can satisfy the 100 hours requirement. This question about a DAF, a CLAT is better than a DAF in our view because it gets you the same deduction as a DAF. That's a donor advised fund, but you also get to keep that money at the end. So it's strictly superior. There's a cost to it and there's some constraints, but mathematically it beats a DAF every time. The last point I want to make here on as far what Farhan was talking about, the way I think about this as compared to, say, conservation easements, is that conservation easements were a loophole, were a clever reading of the charitable deduction rules that the lawyers and accountants made up to get their clients major deductions. And the IRS wasn't happy about that. Solar, oil and gas, CLATs, charitable remainder trusts, all of the strategies that Valor pursues are not loopholes. They are things that are written down in statute and regulations and that were invented for the purpose that we're using them for. I think that's a really important distinction. We are not repurposing the ownership of a medical patent to get a tax break. That's a clever move, but one that could bring scrutiny. We're doing things that are written down in the code and in the regulations, and we're doing them by the book. And I think that's one reason why literally zero of our clients, knock on wood, have been audited across any of these strategies so far.